Welcome to the Jill on Money Show. It's Tuesday, February 4th, and we are here trying to help you make better or less bad financial decisions. We do that by encouraging you to take some action. What is that action? It's not that hard. It is simply going to jillonmoney.com. That is our website. Probably bookmark it just in case, you'll come back to it. And click the Contact Us button. When you do that, a form will pop up. That is the email that we receive from you. Write us that note. If you don't think you're going to be on the program, give us some details. If you do, check the box. If you do want to come on the program, check the box, and Mark will arrange to get you on the show. Don't forget that you can sign up for our free weekly newsletter right there on the front door. And you can subscribe to Jill on Money Live. That is where you have access to quarterly live webinars. Get it quarterly, 4 of them for the next 12 months. And, you get this back catalog of all the great stuff we do. Excited right now because we know that our next webinar will be on Thursday, March 6th. And that will be with Ed Slott. We talk about him all the time. He is the guy who convinced Mark Talercio to fall in love with a Roth, with any Roth. All Roth all the time, as Mark and Ed like to say. And we're going to talk about the upcoming tax season, maybe some things you should think about for this tax year, potentially changes that could come to the system, maybe the extension of those tax cuts that were set to expire at the end of this year. All of this will be wide-ranging. It's going to be really fun. And with Ed Slott, it's always, always a blast, and he does make tax prep fun. I can't believe it, but he does. So you can only join that conversation, that live webinar, if you are a member of Jill on Money Live, $45 for the next 12 months. Not a bad deal, I gotta say. Okay, let's do some emails. They are pouring in, so let's do it. I'm going to start with this one because we actually got a note last week when you might have noticed that there was that first day of trading last week, Monday, when NVIDIA, the big chip maker, the one that's really been the company that's the sort of the backbone of the AI developing world, NVIDIA tumbled by 17% last Monday. And, it was a funny sort of developing story, actually, because funny meaning not ha-ha, but it was a story because there is a company called DeepSeek, which is a Chinese company. They released their recent AI model that really did seem to perform pretty perfectly with OpenAI. And the thing is that they were able to create this competition for a lot less money and computing power. And so then the thought was, oh my God, maybe people are not going to need these expensive NVIDIA chips. The stock tumbled. They raised $600 billion of market cap, got everyone's hair on fire and all that. Now, that is to say that Chris wrote us a note. I own about 2,500 shares of NVIDIA, which has appreciated 300 to 400% from my purchase price. This is just an investment. I don't need the money. By the way, it's like a $300,000 position. So, frankly, when there's price fluctuations of, 20 or 30 bucks, the gain and loss swings around. So here's what Chris writes. When it goes up, of course, I'm happy. When it goes down, I always think I should have sold before. I check 4 to 5 times every day what the price of NVIDIA is. Is this typical? Please let me know. Listen, if it is money that you don't need and it is really in the less than 10% of your overall investments, then you already made your bet with the devil. I think that what's funny about this is people who own stocks that are on moonshots or even crypto that's been on a moonshot, you're just reluctant to sell. So I don't know what to say. I don't really own stocks not to get out of them. And, it's different than saying I own the index and I'm just going to stay in it. But if this is just your fun money, maybe you should be thinking about every time it goes up by a certain percentage that you'll sell a little bit. And you can always keep some money on the sidelines. But I just find it odd that the discipline of selling is so much more difficult. So that is the behavioral part of what you mentioned, Chris. I think it's much better that if you are going to own individual holdings, that you should say to yourself, oh, okay, well, on the day after that, let's say NVIDIA tumbled, So this is a stock that reached, almost $150 a share. So the question is, at $150 a share, is that a stock you want to buy again? That's a really good way to test whether or not you should be selling. Or even if it went from 150 down to 120, do you say at 120, yeah, this is a compelling stock? At some point, you've got to ask yourself, what is it that would keep me in this position? Or why am I checking this 4 or 5 times a day? That seems maybe that you have too much in this one holding. Just my 2 cents. All right, this is from Patty. Hello, Jill. My husband lost his job at the end of January. He's 62 years old. Our health insurance was $300 a month, and now it's $1,200. Oof, that's a big one. Okay, Patty's retired. She's 64. And she just filed for her own Social Security benefits so that they could cover their health insurance costs. I don't know about that decision, but she's done it already, so I don't know if you can undo it.
I think she can.
All right. Let's put a pin in that. So my husband is doing some consulting, but it's certainly not the 6-figure job that just ended. We have a healthy $4.2 million in investments. Are you crazy? Why is she filing for Social Security? Since the 2024 market was so good, we actually made $800,000. But I believe stocks are going to fall this year. Listen to this. Since we haven't seen this much growth since 97 and we're retired, we have to start withdrawing from our investments. I want to take $400,000 out of the gain and put into a high yield account with our financial firm so as not to lose it. We don't have 20 years to make up for a 40% loss or more. What are my thoughts? First of all, undo that Social Security filing. It's ridiculous. You've got $4.2 million, okay? And you're worrying about an extra $900 a month? I mean, this seems insane. This is a silly thing. Like, that is not a reason to file for Social Security. So let's think about this. Of your $4.2 million, how much is in stocks? That's my question to you. If you're telling me that you've got like a 50-50 portfolio and everything's balanced, that's fine. I wouldn't touch a thing. If your $4.2 million is all in stocks, then sure, I'd be thinking about whether or not you should be rotating into a less risky asset class, maybe like bonds. But would I go to cash? No. I would have 2 years of your living expenses in cash somewhere, whether it's the money market, a CD outside of this firm's management, just a bank, whatever. But I mean, this is insanity.
I think they actually probably are all stocks. And she thinks they're going to lose the $800,000 gain. She thinks it's going to be wiped off the table this year. I love these projections.
Oh my God, that is crazy. Unbelievable. Okay, this next email, it's from Gary, who writes, Hi, Jill. I enjoy your weekly email newsletter. Hey, Mark, that's for you. So, hey, Mark, that's all about the newsletter. Congratulations. Okay, he also enjoys our podcast. He goes, I even purchased your last book, my most recent book, The Great Money Reset, and found it useful. I have a question I think that could be simple, but maybe not. So Gary goes on and writes, I will be retiring from my full-time job in May of this year. My wife and I are 66. She is already retired. I have worked out a deal with my current employer that I will be working for them starting on May 1st as a contractor. I love this idea, supporting a sales territory. I'm hoping to make about $30,000 per year for the foreseeable future. It's a conservative number, and it could easily double if I were to sell a lot. Now, we would like to have about $9,000 a month to live on. We have our portfolio professionally managed. It's in a mediumly conservative program that is rebalanced regularly. Okay. I asked my financial advisor to start to draw funds from my IRA at $4,000 a month, starting at the beginning of this year until it is depleted and then move on to our other IRA. I did this because I was planning on retiring in January. My employer asked me to stay on full time for a few months, so that's why retirement got pushed off to May. I don't need the $4,000 at this time, so I'm taking that money and fully funding our Roths for 2025. Once they're fully funded, I plan on reinvesting any excess money in my brokerage account. Is this a sensible strategy? I am attempting to reduce the money in my 401k and traditional IRAs as much as possible now so that we'll have lower RMDs in the future and, of course, more money in the Roth accounts. As long as I continue to have earned income and have excess cash flow, should we continue to fully fund the Roths? Yeah, why not? I love this plan. Don't you, Mark? It seems like a great plan for Gary and his wife.
Yeah, I mean, I would love some more information, such as the numbers, but yeah, from what he tells us, sure, why not?
Exactly. I mean, gang, what I want everyone to hear in all of this is that as you look ahead, if you are in a period of time where you know that your tax situation is going to be putting you in a lower bracket, why not take the money out? And I don't know the other aspects. We don't know how much taxable income his portfolio might have and this, that, and the other thing. But, if you think about it, $4,000 a month, right? And you got almost 50 grand a year and he's making the 30. And I mean, he could be in the 12% bracket. And the only risk he has is just if he starts kicking butt on his income and he pops into the next tax bracket, what would that do? But I don't know. It could be fine. I think it'd be all right. We'll see. But if you need more on this, just get back in touch with us. Okay, this is from Kay, who says, "Hi, Jill and Mark. Big fan of the pod. Keep up the great work." Okay. My partner and I are feeling less and less enthusiastic about going to work these days. Our vices are travel. We'd like to do more of that while we're relatively fit and able to do so. We've got 2 kids, one launched, the other 85% launched. I'm 61. Partner 62. We would love to call it quits next year when we're 62 and 63, respectively. Do we have enough to retire? We live in a high cost of living state. Okay. Ready for, I'm going to first look at this. Right now they spend about 140 grand a year. Okay. This is interesting. So their income, they make 220 right now. And they got a lot of money. Let me just add this up quickly. So it's 1.1 in traditional retirement assets, 360 in a Roth, 420 in a brokerage account, 45 grand in an HSA, $67,000 in cash. There are 2 scenarios. You ready for the 2 scenarios, Mark? One is retire next year and claim Social Security. Why are we claiming at 65? Does she mean 67? I hope you mean 67 because I don't want you to claim at 65. We want you to claim at 67. So I'm going to just say that retire next year, okay? And I think she means looking at 62 and 67, I think. They will have income in retirement, Social Security of, let's call it about $5,000 a month that comes from Social Security, okay? Now, remember, their pre-tax expenses, they're pretty high, 140 grand. Don't you think? I mean, I know that when you think about like what they have, but we got to create 12 grand a month in income, right? 5 is going to come from Social Security. Then the question is, I'm trying to figure out what's happening. Is she giving me the income for both of them or each of them? How do you read that, Mark?
I think
because one says 62 and one says 65.
Yeah, I read it as it's both of them combined.
Oh, you do? See, I'm not sure. Okay, so all right, let's just say this. There's at least 5 and maybe 7, maybe it's 5 grand from Social Security, then another 2 in a pension. So the question is, if they had 7 grand a month of income, could their let's call it their $1.8 million portfolio create the balance of that income?
Yeah.
Yeah, sure.
But they're going to have to spend for 3 years or so.
Exactly. So here's what I would say about this. First of all, I'm much more interested. My scenario that I'd love for you to follow up with us is do not send us anything at 62. No one's claiming Social Security at 62 unless you tell me you're in terrible health. That's number one. So I want to see the numbers for 67 and 70 for each of you. Okay, so just say me and then say partner, and then we can better assess this. But, remember, you're going to have to spend down some money. Every scenario is retirement friendly. It's just a question of what you choose to do. All right? That's what I would say. Don't stress too much. It's just we need a little bit more information. Mark, I have one last thing, and you don't know about this, but I wanted to just give you I had a conversation with somebody recently, and I just wanted to play this out for our last question of the day. And that is, what would you say, Mark, if somebody had a net worth of, let's say, equity in real estate, $1.5 million, and another $1.5 million invested, $3 million total of net worth, but feeling very financially insecure because that equity is tied up in the house, 50 years old, single. Are you somebody who would think about selling the house to free up the equity, even though they may even have to pay a little bit more in expenses in the near term just to kind of get resettled? But the lack of access to the equity for a 50-year-old who's on his own, how do you think that plays into the decision making?
I mean, it's, it always sounds easy peasy and, really appealing. Oh, I'm just going to sell and move into something cheaper. Can this person actually find something cheaper that will work?
I think they can find something that will be at least, it will not be as cheap as just owning the house. Let's say that because the house has a tiny mortgage left. Okay. So if it's a $1.7 million house, it only has $200,000 in mortgage, but it's an interest only mortgage. It was purchased recently. It's going to pop on them. It's tough. I've been asked this question in a lot of different ways, just from people who are renters, and they say, I'm never going to be able to buy. Is it better to have the equity working for me, the money I would be sinking into a house or a house payment? Am I better off having, that as accessible money? I just think these are really personal questions, and they often come down to, hey, are you willing to make a change in just how you're living? And I think that's the other piece of it. So look, if you've got a question about housing, the housing market is, how shall we say, this is a Yiddish word, Mark, so don't have to bleep it. It's verkauft, meaning it is really upside down, and prices are up by almost 50% in 5 years. The affordability is a real deal. Mortgage rates are not going down anytime soon. So if you're somebody who is wrestling with, should I sell my house, free up the equity, be a renter? Should I try to do that? Am I somebody who really needs to think about how to get more liquid? We'd love to hear from you. I think this is a fascinating question at this point in the cycle. So just shoot us a note. Go to JillOnMoney.com, click the Contact Us button. Let us know if you'd like to join us on the air live. Don't forget that you can actually sign up for the free weekly newsletter. It comes out every Friday. It's right on the front door of the website. Subscribe to us on the Odyssey app or wherever you find your favorite podcasts. And don't forget to lift someone up. Change your work, change your wealth, change your life. Thanks for listening. We'll talk to you tomorrow.